It is December. You open your banking app. The balance looks intact. Every deposit is still there. The number has not been cut in half. No red warning lights. No emergency headline. No visible crisis. And yet the deception is already complete. The rent is higher. Insurance is higher. Food that used to feel routine now requires calculation. Utilities rise in small steps. Then all at once, a repair you could absorb last year now forces a decision. Nothing in your account statement says you were robbed. But out in the real world, where money has to become heat, shelter, transport, and time, the loss is obvious. This is the most effective form of wealth destruction because it does not look like destruction. It looks like stability. Most people are trained to watch for the dramatic event, the bank failure, the crash, the currency break, the panic queue outside an ATM. But financial repression works differently. It does not need spectacle. It only needs patience. It only needs a population that still believes preserving the nominal number is the same thing as preserving wealth. That is a mistake, because a saver can lose 20% of his economic position while his statement remains unchanged. A retiree can obey every rule, hold the approved instruments, avoid leverage, avoid speculation, and still become the funding source for a debt problem he did not create. Not through taxation in the visible sense, through dilution, yield suppression, and time. This video was about that mechanism, not inflation in the abstract, not market forecasting. The actual policy logic by which indebted states reduce the real burden of their obligations by holding you returns below the rate at which your life gets more expensive. And more importantly, what has historically survived it? The official story is always softer than the forensic record. You will be told that inflation is complicated, that deficits are manageable, that central banks are independent, that temporary price pressures, supply disruptions, labor shortages, energy shocks, and global instability are unfortunate but normal features of a modern economy. Some of that is true, but it misses the governing reality. When a state carries a debt load too large to repay honestly, too politically dangerous to default on openly, and too large to outgrow quickly through real productivity, it has only a few options. It can default. It can impose explicit austerity. It can raise taxes to a level the public will feel immediately. Or it can do something quieter, hold interest rates below the true inflation rate and let time do the liquidation. That last option is financial repression. It is not mystical. It is arithmetic. If the government owes trillions at fixed nominal values and the currency loses purchasing power faster than the interest owed on that debt, the real burden of repayment falls. The bondholder gets paid back, but he gets paid back in money worth less. On paper, the contract is honored. In practice, value has been transferred. This is why the regime is so politically useful. It spreads the pain across years. It obscures responsibility. It punishes slowly enough that many people misdiagnose the source of the loss. They blame greed corporations, whether war logistics, anything except the structure sitting in front of them, a system in which safe yield is administratively kept beneath real inflation, so sovereign debt can be melted down without the word default ever being used. And once you see that, other pieces fall into place. Why are savers encouraged into safe, fixed-income products that guarantee a real loss? Why are banks, insurers, and pension funds treated less like free allocators of capital and more like reservoirs of captive demand for government paper? Why does policy language obsess over stability, while the purchasing power of wages and savings keeps degrading? Because repression only works if the public continues to confuse nominal preservation with real preservation. That is the promise of this video. We are going to examine the historical record, not the slogans. We're going to look at how states have done this before, who got trapped first where value fled, and why the people who survived best were usually the ones who stopped asking whether the number was stable and started asking whether the claim itself was being quietly hollowed out. The cleanest autopsy is the United States after the Second World War. In 1946, federal debt held by the public had exploded to levels that would normally imply either severe austerity, outright default risk, or a long political struggle over who would absorb the loss. Instead, the system chose a quieter path. The debt was not repudiated, it was diluted. The mechanism was simple enough to explain in one sentence and powerful enough to shape an era. Keep government borrowing costs low, while inflation runs above those yields for long enough that the real value of the debt shrinks on its own. This did not happen by accident. It was enforced through policy architecture. Under the wartime and immediate post-war rate regime, Treasury yields were effectively capped. Short-term bills were held near very low levels, and longer-term government bond yields were constrained as well. That meant a saver could hold what looked like a respectable sovereign claim, receive his coupons on time, and still lose purchasing power year after year if prices rose faster than the yield he was allowed to earn. That is the crucial distinction. The government did not need to cheat on the nominal contract. It only needed to ensure that the real contract was unfavorable. At street level, this feels very different from the textbook description. A household does not experience negative real rates as an elegant macroeconomic variable. It experiences them as drift. Wages rise, but not cleanly enough. Prices jump where life is least optional. Food, housing inputs, transport, medical costs, household replacements. The family still has savings. It just takes more of those savings to maintain the same life. The account survives. The standard of living does not. This is why post-war debt reduction is so often remembered as a triumph of growth, while the repressive component gets softened or ignored. Growth did matter. Demographics mattered. Industrial expansion mattered, but those forces alone do not explain the speed with which a massive debt burden became manageable. A major part of the answer is that the liabilities were being worn down in real terms, while the holders of financial claims were prevented from fully defending themselves. And note who paid, not the sophisticated debtor with fixed obligations and access to real assets, not the owner of scarce productive property with pricing power. The quiet losers were the holders of cash, deposits, and government paper yielding less than inflation. In other words, the people doing what the system described as prudent. This is the template that matters in 2026, not because the present will repeat the 1940s word for word. It will not. The institutions, capital flows, and political language are different. But the governing incentive is identical. Highly indebted states always search for the least visible path to debt reduction. And among all available methods, sustained negative real returns on nominally safe assets remain one of the most politically survivable. The lesson from the post-war period is not that governments sometimes prefer inflation. The lesson is sharper than that. When debt becomes too large, safety is often redesigned to serve the issuer, not the saver. For financial repression to work, the state needs more than inflation. It needs buyers who cannot easily walk away. This is where the system stops looking like economics and starts looking like channel control. Banks need high-quality liquid assets. Insurers need reserve assets that satisfy regulatory standards. Pension funds need duration, liability matching, and politically acceptable instruments. In plain language, the largest pools of institutional money are not free to allocate purely on the basis of real return. They are governed by rules, capital treatment, solvency frameworks, collateral standards, and career incentives that push them towards sovereign bonds even when those bonds are poor stores of purchasing power. That is the trap. A pension manager may know perfectly well that a long-duration bond yielding below inflation is a losing proposition in real terms. But the mandate is not to behave like a sovereign dissident. The mandate is to remain compliant, liquid, benchmark-aware, and institutionally survivable. A bank treasurer does not get rewarded for saying the system itself is confiscatory. He gets rewarded for holding what regulators classify as safe. So demand for government paper is never just market demand. A large share of it is manufactured demand. That matters because it changes the meaning of the price. A low sovereign yield does not necessarily mean the bond is genuinely attractive in real terms. It may simply mean enough major actors are required, pressured, or incentivized to own it regardless. At street level, this institutional architecture creates a second illusion. The public assumes that because pensions, banks, and retirement vehicles hold so much sovereign paper, the asset must be truly safe. But institutional prevalence is not proof of real protection. Often it is proof of regulatory privilege. And once you understand that, you understand why repression can last longer than many expect. It is not just that savers are passive. It is that the largest financial organs in society are structurally drafted into absorbing the state's funding needs. The losses are then distributed outward through lower retirement outcomes, weaker real savings growth, more fragile balance sheets, and a public that discovers too late that conservative did not mean preserved. It meant contained. This is also why individual defense has to begin with one uncomfortable admission. If your portfolio is built mainly from instruments the system most wants you to hold, you are probably not positioned for your own protection. You are positioned for the regime's convenience. So where does the repressed value go? It does not vanish. It relocates. When nominal claims are held below the inflation rate, capital begins looking for assets tied to reality instead of promises. Not glamorous stories, not speculative fantasies. Reality. Assets linked to output, scarcity, replacement cost, and pricing power. This is why value equities tend to reassert themselves in repressive periods, not because every cheap stock is a refuge, but because businesses that own hard assets, essential distribution, energy, exposure, commodity linkage, or the ability to pass rising costs into final prices, are not trapped in the same way as fixed nominal claims. A bond coupon is fixed. A productive enterprise can adjust. Slowly, unevenly, imperfectly, but adjust. The same logic applies to productive land. Land is not protection because it is romantic. It is protection when it is useful, financeable, and connected to something people continue needing under pressure: food production, rent, storage, energy corridors, logistics, mineral rights, water access. In a repressive regime, the question is never, is this asset prestigious? The question is, does this asset participate in the repricing of the real world? Then there is non-sovereign money. Historically, when confidence weakens in the state's willingness to preserve purchasing power, capital searches for monetary alternatives outside the direct liability structure of the sovereign. Sometimes that means precious metals. In more recent periods, some investors extend that category to digital bearer assets with a fixed issuance logic. The point is not ideology. The point is distance from the balance sheet being rescued. And then there is the reversal most people miss. Fixed-rate debt can become an asset. In a disinflationary world, debt is a burden. In a repressive inflationary world, long-term fixed-rate debt secured against a useful real asset can become a transfer in your favor. If your mortgage is locked while the currency weakens and nominal incomes and asset prices rise over time, the real weight of that liability falls. The debt does not disappear, but it is being paid back with cheaper future dollars. This is why repression punishes the unlevered saver more harshly than the prudent holder of fixed-rate liabilities attached to productive collateral. The pattern is consistent. Claims get hollowed out. Collateral gets repriced. Fixed coupons fall behind. Scarce utility absorbs the escape flow. And that leads to the practical question. How do you inspect your own balance sheet before the transfer is complete? Start with one division and make it brutally honest. On one side, list everything you own that depends on a fixed nominal promise: cash, bank deposits, money market exposure, bonds, bond funds, annuities, pensions with uncertain real adjustment, and any retirement structure dominated by fixed income claims. On the other side, list everything linked to real repricing: productive equities, useful land, commodity exposure, precious metals, non-sovereign monetary hedges, and owner-controlled fixed-rate debt attached to durable assets. Then ask 4 questions. What percentage of your net worth is earning a return the issuer can cap? What percentage is trapped in instruments presented as safe because institutions are required to hold them? What percentage can reprice with inflation rather than absorb it? And what fixed-rate liabilities become easier to carry if the currency keeps weakening? That is the core of the real asset allocation test. Not a magic formula, not a universal portfolio, a diagnostic, a way to see whether your household balance sheet is positioned like a saver inside a debt liquidation regime, or like a citizen who understands what the regime is doing. There are caveats. Real assets are volatile. Land can be illiquid. Equities can be mispriced for long periods. Precious metals produce no cash flow. Digital monetary hedges carry regulatory and custody risk. Debt only helps if it is fixed, serviceable, and attached to something worth owning. This is not permission for recklessness. It is a warning against sleepwalking, because the wealth transfer does not announce itself as theft. It presents itself as prudence. It tells you that because the statement balance is still there, the danger has passed. It has not. In periods of financial repression, the central choice becomes very simple. Hold claims the system can quietly hollow out, or hold pieces of reality that can force repricing.